Good morning and welcome to the Price-Cong Important Tax Provisions from the recently enacted COVID relief bill presented by Spencer Bunn. This is being recorded and will be up on our website later today. Additionally, if you would like to have the slides, we are happy to send those to you.
Thank you, Don. Good morning, everybody. Thank you so much for joining us this morning for this presentation about the tax provisions and changes from the recently enacted COVID relief bill. I'm Spencer Bunn. I'm a CPA here at Price-Cong. I've been here at this firm about 7.5 years and have been in public accounting now almost 13 years. It'll be my 13-year anniversary first week of February. Thank you so much for joining us today. So the first thing I wanted to discuss that was passed in the COVID relief bill, and of course you guys have seen a lot of press about this, so there's probably not too much new ground I'm blazing here. But there are a few things I did want to discuss about the stimulus checks. As you're all well aware, the IRS started issuing round 2 of stimulus checks, and they were passed under effectively the same standards as were passed under the CARES Act last March for single individuals with under 75 grand of income or married couples under 150. Additional stimulus checks were released to those taxpayers. Really the only changes were the amounts. This go around, individual taxpayers received $600 per adult as opposed to $1,200 back in round 1. And then for dependent children of those same taxpayers under the age of 17, they got $600 per child, whereas it was $500 in round 1. Now, one important thing to know about this second round and first round, for that matter, of stimulus payments is that when they enacted both of these, they structured them in such a way as to be an advance on an additional tax refund. They created an additional tax refund in the law and were basically paying people in advance based on what their 2018 or 2019 income happened to be. When everybody files their 2020 individual returns, what's going to end up happening for everybody is that there will be a reconciliation on that return where, based on one's 2020 income, there's going to be a reconciliation of what your stimulus payment should have been versus what you actually received. And here are the important points about that. If, for example, you received more in stimulus money based on your prior year income from 18 or 19 than your 2020 income justifies. So let's say, for example, you're a married couple. In 2019, your income was $80,000. And for whatever reason, a promotion, a bonus, what have you, in 2020, your income was $200. Based on your 2020 income, you wouldn't have been owed any stimulus, but you would have received both round 1 and round 2 of stimulus based on your 2019 income of 80 grand. If you happen to get more than what you were ultimately entitled to, ultimately the IRS says, that's okay, we're not going to make you pay it back, you can keep the money. Importantly, if it goes the other way, if you received less than you should have, so let's say, for example, let's flip the script of my prior example, you earned 200 grand as a married couple in 2019 and therefore weren't entitled to anything. COVID hit you hard, it hit your business hard, maybe you lost your job, and now your income in 2020 is only 80 grand. You will be able to receive the stimulus that you did not get before, as it'll either be an additional refund on your 2020 tax return if you're already in a refund position, or if you happen to owe money, it will reduce or eliminate any amount that you happen to owe. Moving on from that, there were a variety of provisions in this new law that were extended, and this is something that happens every year. There are dozens of provisions in the tax code where Congress puts an expiration date on them. And invariably at the end of every year, they pass a bunch of them. A few of them are left on the cutting board and done away with. But I wanted to walk through some of the extensions, some of the more notable ones anyway, that were passed as part of the COVID relief bill. The first one, or the first group of extensions, these were permanent ones. So these are ones where there's no expiration date on them anymore, at least not so long as Congress makes another change. The first of which is the 7.5% of income medical expense floor for itemized deductions. So this is a floor that had been in place for a long time. And then when the Affordable Care Act was passed just over a decade ago, it had moved the floor up from 7.5% to 10%. It had been there for a few years until after Trump was elected, Congress moved it back to 7.5%, but on a limited timeline. With the COVID relief bill, they've now made that permanent. One other permanent change, the lifetime learning tuition credit. This is one of the college tax credits available for individuals in school. The income limits under which one can claim that credit have been raised, and they now match the same income limits for the American Opportunity Tax Credit. So if you're a single individual with 80 grand or less in income, or a married couple with 160 or less, this is a tuition tax credit that is now available to you. Moving on from the permanent extensions, there was one 3-month extension, and I'm going to go into much greater detail about this later in the presentation. The payroll tax credits that are available for the payment of employees that are sick due to COVID-related reasons. They were set to expire at the end of 2020, but they've now been extended through the end of this March. Some notable 1-year extensions through the end of this calendar year. The deduction of mortgage insurance premiums as itemized deductions. This is limited for individuals who have $100,000 or less in adjusted gross income. The non-business energy property credit. So this is, the purchase of energy efficient windows, solar water heaters, and some other, shall we say, environmentally friendly upgrades to your home. This is a credit that in one's life, you're allowed to max out at $500. There's also the electric vehicle credit. So everything from various models of Tesla, Toyota Prius, various other hybrids and other electric cars. Depending on the car and how much of that vehicle has been sold, tax credits are available on the purchase of a new electric vehicle of up to $7,500, depending on the vehicle. And then one other 1-year change. This is one that was originally enacted in the CARES Act. The income limitation for donating to charity, your deduction for charitable contributions in the past, it had been limited to 60% of your income. Under the CARES Act, they raised it to 100% for 2020, and they've now extended that 100% limit to 2021. There was one 3-year extension, the solar tax credit, which was set to expire this year. It was going to be 22% in 2021 and then go away entirely. What has happened instead is the 26% credit, which was in effect for 2020, has been extended for 2 years through 2021 and 2022. And then it'll drop to 22% in 2023, after which point it falls away entirely. Some 5-year extensions, the work opportunity tax credit. So this is a tax credit that is available to businesses that hire employees in certain defined categories. To give a few examples of what those categories are, the hiring of ex-felons, disabled veterans, people who have been unemployed for 6 months or more. There's a handful of other categories. The way this tax credit works is it's one where you basically have to certify through, if you're based here in Arizona, you certify it through, I believe it's the Department of Economic Security. You certify through them that your employee is in a particular class. And then once certified, as long as you keep that employee on your payroll for at least 6 months, depending on which category they fall into, you can obtain a tax credit that ranges from, at the bottom end, $1,200 to as high as $9,600. Another 5-year extension, the principal residence canceled debt exclusion. This is something that, at least over the last several years, we haven't seen too much of because of the increase In real estate prices, we saw a lot more of this in 08, 09 when everything hit the fan. If you have a foreclosure and there is outstanding mortgage principal, or if you have a short sale or a deed in lieu, then up to $750,000 of that debt is considered to be tax-free. It used to be $2 million, but with the COVID relief bill, they moved it down from $2 million to $750,000. So that was one tweak that they made. Family and medical leave. Normally this leave is not paid by employers, but if there is an employer who does pay it or chooses to pay it, there is a payroll tax credit available to them for the payment of this leave. It generally works out at up to $200 a day for the wages of the employee who's on such leave, and that credit maxes out at $10,000. And then student loan payments to employees. There's been a longstanding provision in the tax code whereby employers can give up to $5,250 of tuition assistance to their employees and it not be considered taxable to the employees. Under, and I don't recall if it was either the Secure Act at the end of 19 or the CARES Act, they added a provision whereby employers could pay employees up to $5,250 to help them reduce their student loan debt, and that would not be taxable to the employees. So that was something set to expire at the end of 20. It's now going to be in place through at least the end of 2025. Some new provisions. This first one really wasn't new, but it was something where, and I'm going to go into it in detail later on at length, but it was practically unavailable the way they originally passed it, and now it is much more available. The employee retention payroll tax credit is now available to PPP loan recipients. I will be spending a lot of time at this at the end because I think those of you watching this today are going to find a lot of value in what that tax credit makes available. The bill also included an increase, business meals for the longest time. You could only deduct for most businesses 50% of the cost of business meals. They've now enacted a 100% meals deduction, and that is in place through the end of 2022. Ostensibly, the reason for this was that they wanted to help out struggling restaurants and make it more, to basically incentivize businesses to go out more. It does limit this 100% to purchases from restaurants. The reality, though, is that 99% of meals are purchased from restaurants. So it's not much of a limitation, in my opinion. And then there was the creation of a new charitable donation deduction available for those who don't itemize, who take the standard deduction. There was a provision for this that was passed under the CARES Act for 2020, whereby people who don't itemize their deductions can deduct up to $300 of their charitable deductions. And that's for every taxpayer. For beginning next year, the provision is that for single individuals, you can deduct up to $300, or married couples up to $600. And this is for those who do not itemize their deductions. So the Paycheck Protection Program, as many of you are no doubt aware, Congress passed round 2. And I wanted to walk through both what round 2 entails, as well as, well, what if I didn't get a PPP loan before and I want to get one now? So in the latter case, if you did not originally get a PPP loan and you're now planning to do so, they are available under essentially the very same terms that were available in the spring when they first passed PPP under the CARES Act. Lesser of $10 million or 2.5 times your monthly payroll, and it's pretty much available to any business if it's your first go around. If it's your second go around, if you got a PPP loan the first time and now you're looking to go back in, they did put some significant limitations on this. The most significant of which is that you have to demonstrate that in any 2020 calendar quarter, you had at least a 25% drop in your revenue versus the same calendar quarter in 2019. I would reckon that for most businesses, the quarter that you're going to want to look at is second quarter, because that's when everything hit the fan. That's when everything was shut down. That's, for most businesses, going to be the most significantly impacted quarter. So you do have to demonstrate that to get a second round of PPP loans. The employee limitation is now less as well. It was 500 under round one. It's now 300 or less employees under round two. And the maximum loan is also less. It's the lesser of 2 million, or 2.5 times monthly payroll in round two. They did add a provision where if you're in the food service or accommodations business, so you're a restaurant, you're a hotel, you're allowed to take the lesser of 2 million, or 3.5 times your monthly payroll as opposed to 2.5 times. Before I continue, Don, are there any questions in the chat that you would like me to answer?
Not at this time.
Okay, thank you. I wanted to do a deeper dive at this point on the COVID sick leave payroll tax credit. This was something that was enacted as part of the Families First Coronavirus Response Act. This was passed in the middle of March last year, just a couple of weeks before the CARES Act. The thing from this particular legislation that got the most press was the imposition of sick leave requirements on smaller employers, requirements that as of the end of the year have since expired. Among other things, this legislation also provided an expanded payroll tax credit for family and medical leave, which I discussed previously. The one, though, I wanted to focus on here in the next couple of slides, we'll dive in on, is the payroll tax credit for employees that are out of work for COVID-related issues that I'm going to define in a minute. This was something that, when originally passed, was not very accessible because COVID was only so rampant at the time. Obviously, since then, it has become way more widespread and way more prevalent than it was originally. And I think at this point, it's safe to say that most, if not all of us, probably know someone who's had COVID, or maybe even know someone who's passed away from it. And as a result, this is a payroll tax credit that is now much more accessible. This payroll tax credit maxes out at over $5,000. And I'm going to walk you through the circumstances in which one can qualify for this payroll tax credit. And these I've taken straight from the code. There actually is a sixth one, but it is so convoluted and difficult to understand and probably applies to no one that I didn't even bother including it. So the ones that are of relevance, you're an employer and you have an employee subject to a federal, state, or local quarantine or isolation order related to COVID-19. An employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19. The employee is experiencing symptoms of COVID-19 and seeking a medical diagnosis. This is the one that will probably apply to most people, because this is when people are getting sick with COVID and they either test negative or positive. The employee is caring for an individual who meets one of the first two conditions above. Or the employee is caring for a son, one of their kids who their school or childcare facility has been closed or is otherwise unavailable because of COVID-19. If you have an employee who meets any one of these standards, so you have an employee, they email you and they say, I've been really sick, I just got tested for COVID, I tested positive, I'm going to stay out for a few days or however long it takes for them to heal. And let's say, for the sake of argument, that they're out of work a week, and this employee gets paid $300 a day. That's their wages. In that particular instance, you'll be able to take a tax credit on their wages for the time you paid them while they were sick with COVID. So in that particular instance, you could obtain a tax credit of up to $1,500. Understand that this tax credit, it is per employee. So if you have an outbreak at your office and 6 employees are all sick at the same time, or maybe at different times, and everybody's out a week and everybody gets paid $1,500 of sick leave while they're out with COVID, 1,500 times 6, $9 grand of tax credit in that particular instance. Now, some other noteworthy things about this tax credit. The maximum, so On the prior page, if it's any one of the first three conditions, the maximum is up to 511 a day of employee wages for up to 10 days. So it maxes out at 5110. If it's one of the latter two conditions, the credit is less, but still not insignificant, up to 200 a day for up to 10 days, maxing out at $2,000. Some other important, very important elements of this. If you're like, oh my gosh, I wasn't even aware of this, I've filed my payroll tax returns for second, third, fourth quarter 2020. What do I do? That's okay. You can go back and amend them and designate that certain wages were eligible for this credit based on who you paid that was sick because of COVID, and go back and claim a refund. This is also something that you can do on an ongoing basis if you're working with your payroll provider. If you let them know or put it in your payroll that somebody was paid sick leave because of COVID, then they can reduce the amount that they sweep out in your payroll tax deposit run so that you benefit from the credit that way. Some other important elements: if you're self-employed, you're somebody, you don't have any employees, you work for yourself, maybe you just have a single member LLC, you report everything on a Schedule C. Let's say you come down with COVID and you're out for a little bit of time. This payroll tax credit is also available to that group of people. It's calculated a little bit differently for them. It's based on their self-employment net income at the end of the year. So to give a really general example, let's say you're self-employed, and to keep things simple, your net income for the year was $52,000, which averages out to $1,000 a week. If you're sick for a week, you may very well be eligible for a $1,000 tax credit in that particular instance. Another notable thing is that to the extent that as an employer you pay for your employees' health insurance, that amount can be added to the wages in terms of calculating the credit. So if I go back to my prior example, I said if you have an employee and they're paid $300 a day for 5 days, you get $1,500. Let's further stipulate that employee's health insurance premiums you pay for are $400 a month, which we'll say is $100 a week. So while they were sick, you paid them $1,500 in wages and paid for $100 of their health insurance. So really the tax credit in that situation is $1,600 instead of $1,500. Now, one important caveat with this particular payroll tax credit is how it interacts with and reconciles with one's PPP loans. The law does provide that you can't double dip. In other words, if you use wages to claim a payroll tax credit under this provision, those same wages cannot also be used for PPP loan forgiveness. It's either or. The thing that I would generally advise here is that as you're putting through your PPP loan forgiveness applications, which I know many people are doing right now that there's a lot more clarity because of the changes passed with PPP under the new law. If you're going through that calculation, for many people, I would suspect that if you're using a 24-week loan period, you're going to have qualifying expenses between your wages, your utilities, your rent, et cetera, that are a good amount greater than the amount of loan you received. And so the thing to basically be mindful of there is if you got a PPP loan for, let's say, $100,000 and you have qualifying expenses of $140,000, you could kind of say to yourself, okay, I have $40,000 a room where if I identify some employees in the past who were sick with COVID and I take this payroll tax credit, I can do so with some wiggle room without hurting my ability to get PPP loan forgiveness. It's something you do have to be careful of, because if you just do it willy-nilly, you may end up shooting yourself in the foot, because you'll get a payroll tax credit, but then you'll end up owing on the back end with your PPP loan. So it's something you do have to work through, but as long as you do so, I think you can get the best of both worlds. Don, are there any questions in the chat about the COVID sick leave tax credit?
Well, we have some questions and I'll go through them. So we have, what period can be used to calculate the 2.5 monthly payrolls previously calculated on 2019 average? Can 2020 average be used for second round?
The answer to that question is yes. You can use either or in the second round. You can either use your 2019, average 2.5 months, or 2020, or a rolling 12-month period that maybe straddles both years. Any one of those three options are available.
And then the other question was average monthly payroll. Is that using the 941s to arrive at this number? If so, what quarter?
Generally speaking, I would say yes, that's true. Because you have to figure out average monthly payroll, you're typically going to use, if you're doing it for 2019, you're going to look at all 4 quarters, divide that total by 12, and then multiply that by 2.5 to get your average monthly amount. Okay,
and then we have one last question. I was unemployed in the entire 2020. I was both W-2 employee as well as 1099 independent contractor in 2019 as an associate dentist.
Okay.
Been receiving unemployment insurance benefit. Is there anything that I need to be aware of? Is this something you're going to cover?
I'm not covering anything with respect to unemployment. Would the questioner be able to provide any additional details as to what information they're looking for in terms of maybe like when does their unemployment expire, or what's the particular concern?
Why don't you keep going and I'll sidebar this and we'll
okay. Okay, that's fair. The thing that I want to focus the most amount of my attention on today is the employee retention payroll. I see right now we have about a half hour remaining, and so I'm going to spend a good deal of time on this. Now, this payroll tax credit, it was originally passed under the CARES Act, and as I walk through this, you're going to quickly discover that it was designed in such a way as to basically be available to nobody. And now under the COVID relief bill, it's now available to a lot more people. So let me walk through the basics of this payroll tax credit and at least lay that foundation. This payroll tax credit was set up to be available to businesses that meet one of the following 2 standards. Either they had their operations suspended in full or in part by a government quarantine, stay-at-home, or other similar order, or, alternatively, they experienced a significant revenue decline, and that's defined as a drop in revenue of at least 50% in any calendar quarter of 2020 compared to the same calendar quarter the year before. And for a business that has such a drop, they remain eligible for this credit until such time as they either recover their revenue to at least 80% in a given calendar quarter versus the year before, or until the first quarter of this year, if that's sooner. And this payroll tax credit, it was designed such that you would pay it, or it would be calculated as 50% of employee wages, assuming you meet one of the first 2 standards, to the extent that you had employees on payroll during that period of time. For the employees impacted by a suspension, or if you experienced a revenue decline for all of your employees, you would calculate the tax credit as 50% of wages up to $5,000 per employee per quarter, with a $10,000 annual max. And these are for employees that are retained during either the business interruption or the revenue decline. For smaller businesses, this tax credit is much more lucrative because it's available on all employees, and I'll get into details as to why that's important on the next slide. Now, originally, when this was passed under the CARES Act, they added a provision that if you got a PPP loan, this payroll tax credit was not available to you at all. And of course, you're probably thinking to yourself, well, then how is this available to anybody? If somebody didn't get a PPP loan, then it's probably also true that they weren't shut down by a quarantine or other order. Had they been, they probably would have gotten a PPP loan, and they probably also didn't have a 1/2 or more decline in their revenue. Otherwise, they would have gotten a PPP loan. So they'd kind of siloed this payroll tax credit. Congress patted themselves on the back and said, hey, look, we gave you a tax credit and nobody can get it. That has now changed as a result of the COVID relief bill. So what happened in the COVID relief bill? There was language passed that retroactively removed the prohibition on this payroll tax credit for those who receive PPP loans. And now the case is that in terms of taking this payroll tax credit, it works very similarly to how I described the COVID sick leave payroll tax credit. You can take it as long as the wages that you use for this payroll tax credit are not also used for PPP loan forgiveness. Some additional changes they made. This tax credit, it was set to expire at the end of 2020. It's now been extended through the beginning of this July. And in 2021, this payroll tax credit is much more lucrative than it was in 2020. It's now calculated beginning in 2021 at 70% of eligible wages. And the tax credit in 2021 maxes out at $10,000 per employee per quarter. Works out to an annual max of 40 grand, but since the credit is only available through the end of June, it's really a max of 20. The revenue decline, again, for 2021, the 2020 rules still apply in order to qualify in 2020, but for 2021, the revenue decline, rather than 50%, has been lowered to 20%. And you evaluate that decline by looking at a calendar quarter in 2021, either first or second quarter, and comparing that to the same calendar quarter in 2019, 2 years prior. And they also expanded the availability of this payroll tax credit on employers who have 500 or less employees as opposed to 100 or less before. So let me walk you through some examples as to how this payroll tax credit works and the potential savings that are available here as a result of these changes. So because Congress made a retroactive change for this, it's probably the case that none of you have taken this payroll tax credit. As I said previously, there was probably nobody who was even eligible for it because most everybody got PPP loans, and the few businesses who didn't would not have met the standards of being suspended or having a steep revenue decline in all likelihood. So now that it's available, what is it that you can do? Well, the first thing you can do is one, evaluate whether you meet one of those two standards. Did you have a revenue decline of more than 50%, and was your business suspended in full or in part? And I'm going to go into what suspension in part means on the next slide, and we'll dive into some information that the IRS has provided about that. But basically, the way this payroll tax credit works is if you had a full business suspension where you could not operate at all, so you were a restaurant and you had to shut down, and to the extent you kept any employees on the payroll, one important thing about this payroll tax credit, it does not look to or make you ineligible if you let people go. If you were a 30-person restaurant and when things shut down, you culled your payroll so that now you only had 5 people left because that's all you could afford, you were eligible for this payroll. You could potentially be eligible for this payroll tax credit on the 5 people you kept. The fact that you let 25 people go because you had no money coming in the door is neither here nor there. So it's going to be important for businesses who either do qualify under these standards or think they do to evaluate whether they do. And if they do, identify, in the case of suspension, which employees were impacted by the suspension, which could have been all the employees or maybe certain employees. Or in the case of a revenue drop, you can take the payroll tax credit on everybody. And the important thing with the employee threshold, where I mentioned before, it's more lucrative if you're under 100 employees in 2020 or under 500 in 2021, is that in the event of a partial suspension, you can, if you're under 100 employees, you can take the payroll tax credit on your entire employee base for the period of partial suspension, not just the employees that you have that were impacted by the suspension. So on this next slide, before I click through these links, I would encourage you, I mean, we are going to be sending out the slides, but what I would encourage you to do right now, if you have your cell phone with you, take it out and take a picture of these links. I'm going to dive into the one at the top. I'll tell you about the bottom two. The IRS established a very helpful set of pages on their website that walk through dozens of frequently asked questions about this employee retention tax credit. And we're going to dive into that in a minute with the some of the time I have left, and then I'll open it up for questions for the last 10 minutes or so. And then these other two articles, I won't be diving into them, but I would encourage you to read them. They were written by Anthony Nitti. He's a CPA out of Colorado, and he wrote two articles. These were, written at the end of the year, so they're just a couple of weeks old. They're quite long, but they're written in layman's terms far better than I could ever attempt in terms of explaining this tax credit in detail, how the standards work, gives you some examples as to, if these circumstances apply to you, this could be the potential credit available to you. So it's really good reading material. So with that, I'm going to dive into some of these IRS frequently asked questions, and I'm not going to read through all of them, but I just wanted to give you guys a taste of what information is available on the IRS website. Now, I'll add a caveat, and the IRS has it here on the top in yellow. They have not yet updated these frequently asked questions for the changes that were made to this tax credit under the recently passed COVID relief bill. Even so, a lot of these questions are still, or the answers to them are still very relevant. And so 90% of what you read here is still going to be pretty on point and is still going to apply, even though they haven't incorporated the changes from the new law into these questions yet. And as you'll see here, they divide the questions into multiple categories, determining if you're eligible. I'm going to dive into this one into a minute, what kind of government orders can be taken into account. And then probably most importantly, what's a partial suspension. As I go through this one, you're going to find a lot of good examples that define what's a partial suspension. And I think what you will be surprised to find in the case of partial suspension is that it is much more narrow than you probably think it is. It can be something as simple as, and they have an example in there for it. Let's say, and I'll give an example that is somewhat in line with the one they give. Let's say you're in the business of construction. COVID hits the fan, it's March, things are shutting down. Your business is largely humming along with one exception. You have a particular job of the many jobs you do where you're in need of lumber. You have a lumber supplier and you were expecting a delivery, but when all these shutdown orders went into effect or whatever, you basically had a supply chain disruption where you did not get the lumber at the time you needed it so that you can construct whatever it was that you were building. And you needed to wait 2 weeks to get the lumber that you were otherwise expecting at an earlier time. Let's say, for example, that for that particular business, it's a larger construction company, maybe there's 250 employees. And as a result of this disruption in being able to get their lumber, you got 10 employees in the company who are working on this particular job, and they now have nothing to do. So the employer decides, well, I'm still going to pay them. I mean, even though I don't have anything else for them to do right now, I'm going to pay them until the wood or the lumber comes in, and then they can resume their work. For that particular employer, that qualifies as a partial suspension. So for those 10 employees who were unable to work and were paid, even though they weren't able to do anything, that tax credit is going to be available to that business for that 2-week period on those 10 employees. Now, here's where the tax credit becomes much more significant. Let's take the same facts, except now this construction company has 80 employees instead of 250. They suffer the exact same suspension under the terms I outlined previously. That construction business, because they're under 100 employees, can take this payroll tax credit not just on the 10 employees who were impacted by the non-arrival of lumber. They can take this payroll tax credit on their entire employee base, even though their other 70 are still working and are still doing their job. They could take it on all 80 employees for that 2-week period. And any of you who are employers and do your own payroll and know what amounts are going out the door every couple of weeks, you're going to quickly realize, holy crap, that is a really big number. I pay 50 grand or 100 grand or whatever it is every couple of weeks for my payroll. So let's just say it's 100 grand and that's your, 80-person payroll, or maybe it's 200 grand. You're going to be able to be eligible in that situation for a payroll tax credit on 50% of those wages. So if you're an 80-person company and you had 200 grand in wages during that 2-week period where you didn't get lumber in the door, you could potentially be eligible for $100,000 of payroll tax credit under this provision. And of course, as you look at this tax credit diving into 2021, where it is more accessible, this payroll tax credit could become much more substantial. If you're a business that qualifies for this payroll tax credit under the revenue decline threshold, if you had a drop of over 50% of your revenue in 2020 in a given calendar quarter versus 2019, or if you had a 20% drop in 2021 in a calendar quarter versus 2019, this tax credit is available for the entire period of time until such time that your revenue recovers to that 80% threshold. So it could very well be possible if you had a really steep drop in revenue in a given quarter by more than half, and let's say you didn't fully recover by the end of 2020, you're going to be eligible for this payroll tax credit for Q2, Q3, Q4. And if you're under 100 employees, you're going to be eligible for this credit on your entire employee base. Now, one word of caution: if you're a business in that particular situation where you could take advantage of this payroll tax credit and really leverage it, you do have to be careful. I'll reemphasize this, to reconcile this with what you're putting into your PPP loan forgiveness application. Because what you don't want to do if you're in that situation and you realize, oh my gosh, I could take this payroll tax credit on everybody for the last 3 quarters of 2020 because I was just hitting the groin. Second quarter, I dropped 2/3 and I haven't fully recovered yet. And I could get, potentially tens or maybe even 100,000 or more in tax credit on all of my employee wages. Well, that's not so great of an outcome if, as a result, you torpedo all of the wages you could then claim as part of your PPP loan forgiveness, and now you owe your entire PPP loan back. So then what's the point? So there is some maneuvering you have to do to make sure that, number one, if you're going to target wages for this tax credit that are within your PPP loan period, that you're being mindful of not taking too much of them out for this payroll tax credit, that you are eliminating the ability of getting forgiveness on some of your loan. But outside of the PPP loan period, it's pretty much carte blanche. You don't have to worry about reconciling those wages with your PPP loan and can pretty much take it to your heart's content. I spoke with a client a few days ago who had just over a 50% drop during the second quarter on their payroll. They kept it's a small business. In prior years, their revenue had been about $1.5 million. They're under $1 million in 2020. They just have a small employee base. It's 5 people, 2 of whom are the husband-wife owners. They kept everybody on payroll, and as we walk through their information, we realized, holy crap, like for those last 3 quarters, there's potentially 50 grand of payroll tax credit. I mean, we might be able to maximize this payroll tax credit on those 5 employees. And this is just a small business. 50 grand would be huge for them to be able to get back, given what's happened to them in their business. So this is something that I definitely think, if you think this applies to you, talk to me, talk to your CPA here in the office. Or if you work with another CPA, talk with them and find out how this can work in your favor. Just to quickly go on the link, I'll just quickly highlight some of the questions here. I'm not going to go through the answers, but it talks about government orders, if requiring non-essential, quote unquote, non-essential businesses to close, but not essential businesses. If I'm an essential business, like how does this apply to me? And here's the one, and this kind of highlights what I was discussing before. If a governmental order causes the suppliers to an essential business to suspend their operation, is the essential business considered to have a suspension of operations? As you walk through this answer, you'll find that, yes, it does actually mean that, if even in part. It also talks about, going down here, number 33, if a governmental order requires an employer to close its workplace, but the employer is able to continue operations comparable to its operations prior to closure. So again, this goes to, okay, I had to shut my office and I sent my 20 employees home. 17 of them were able to work just fine. They logged in remotely, whatever they do. 3 of them were unable to do their job. But I still paid them while, I didn't want to let them go because I need them. And I figured the shutdown was temporary, so I kept them on my payroll. So for that period of time where that was in effect, where those employees couldn't do their job because the workplace was shut because of a government order, then you're going to have a partial suspension in that case. And in that particular case, because you're under 100 employees, you're going to get the tax credit on all 20 of your employees for that period of time that those 3 employees cannot do their job. Going on, if an order requires an employer to close its workplace for certain purposes, but it may remain open for limited purposes, are they considered to have a suspension? Here it says yes, and so you'll see here it gives a bunch of examples as to what that looks like for different scenarios. So there's just a lot of really good information on this. I would encourage you to navigate this a little bit if it's something where you're like, I don't think I had any interruptions. I mean, if I did, they were kind of ancillary and not too impactful. You may find as you dive through this that your not too impactful interruption qualifies as a suspension. And maybe it didn't impact you for a long period of time. Maybe it was a week and it was just a bump in the road on what was otherwise a pretty normal year for your business. You may very well qualify in that situation. So I would encourage you to go through this material. There's a lot of good stuff here. Let's see, let me pull up my thing again. Don, with that, I got 10 minutes left, so I'll go ahead and let you read some questions that I have.
This first one was about PPP round 2. It says, does the 2.5 average payroll include money for equity members or strictly employees?
It does include equity members. There is one caveat with that. The 2.5 times monthly payroll, at least as far as getting forgiveness is concerned, equity partners, you cannot receive forgiveness if they're on any wages that would annualize to be more than 100 grand. So that works out to, per week, it's about $2,000, and just under 2 grand. So up to that level, you would qualify forgiveness on equity partners. In terms of obtaining the loan, I don't believe that, even if your pay is well above that, if you're an equity partner that's making, say, 300 grand a year, for purposes of getting the loan, I don't believe that limits your the loan that you're able to obtain. It does limit your ability to get forgiveness, but not getting the loan.
And then on the employee retention credit, does it matter if the quarterly comparison is cash or accrual?
That is a great question. The IRS has not clarified that. And so that is something that I honestly don't know the answer to. It could very well be the case, and I suspect this will probably be true for some businesses, that they may calculate their revenue decline, and on a cash basis, which may be what they report their taxes on, they definitely have such a decline. But on an accrual or a book basis, which is normally how a business would keep their books, maybe they don't. I don't know that answer. I'll do what I can to find it, and if I do, we'll send an email blast about it. But I'm not 100% sure. This is something that, again, when they made it more available, there was really no clarity given to it. The law just basically refers to gross receipts. Now, normally, when gross receipts is referred to in the tax code, the reference is to what's reported in your tax return. So my inkling would be that that's going to be the place you look. How you report on your tax return is going to be the driving factor, but I don't know that for sure.
Can the employee retention credit be taken retroactively in 2021 without having to amend 2020 941 in year-end work?
Okay, well, not sure that question makes complete sense. You Can you not claim it retroactively? But say the question again.
Can the employee retention credit be taken retroactively in 2021 without having to amend 2020 941s?
Okay, I understand now. Yeah. So if the unfortunate thing is, and well, maybe it's not too unfortunate, it's not too big of a cost, but in order to get this payroll tax credit in 2020, you do have to amend your prior payroll tax returns. Unfortunately, the way they structured this, as I described, it was basically available to nobody for 9 months, and now it's available to a much bigger group of people, and they did that retroactively. So there was really no way for a business that would have otherwise qualified under the now current rules for them to have taken the credit when they filed their payroll tax returns during 2020. So the inevitable reality there is that if you want to claim it for 2020, you have to go back and amend. But I would say, you know what, that's probably a small expense compared to what potential credit may be available to you.
Do we have any other questions? We still have some time left. As we said, this is being recorded and we'll have it up on our website later today. We'll also be sending out the slides to everybody. And if you have any questions, feel free to give Spencer or your other CPA here at the firm or the CPA that you work with, reach out to them to answer your questions. Spencer, do you have any last comments?
I think that's it. This has been wonderful. Thank you, everyone, for taking time out of your day to listen to what I had to present. Really appreciate this. I'm hoping that this will be the start of many more such presentations in the future that will be of value to you. So thank you so much.